Good afternoon, everyone. Welcome to what is, I think, the last session of the day. Congratulations on making it this far. This session is only 25 minutes, so please stick with us for a bit longer. And as an incentive, I can promise you an interesting anecdote about Steve Jobs before the session is over, so please stick around for that. My name is Dan Macklin, and I'm the CEO of Salary Finance, Inc., and I'm based in Boston. And before Salary Finance, I was a co-founder of a company called SoFi based out of San Francisco. I'm very happy and honored today to be joined by David Gardner for this session. For those of you who aren't aware of David's work, he is the co-founder and co-chairman of the Motley, where he also is the chief rule breaker, and more on that later. And additionally, David, he's a busy man. He's also the co-founder of Conscious Capitalism, Washington, D.C. Hello, David.
Hello, Dan. It's so good to be with you and so many watching us today. This is really going to be fun.
I hope so. So the session topic is titled Helping People Start to Build Wealth. And I think myself and David will be looking at that through the lens of what employers can do to help their employees to achieve that goal. And before we kick off, rather, just to mention again that we will try and leave some time at the end for questions. So please do send those in if you have them. Let's dive in. David, both of us work for purpose-driven organizations. At Salary Finance, our purpose is to move working Americans from debt to savings. And at the Motley Fool, you are trying to make the world smarter, happier, and richer. How and why did you start the Motley Fool?
Well, thank you, Dan. Yeah, we started 27 years ago, so it's been quite a while. But we started years before that with a father who taught my brother and me about the stock market. And he wasn't a professional himself. He was a lawyer, but he certainly was not a finance person. But he'd been raised by a father who taught him the stock market, and that we could all be part owners of the products and services that we admire, that we use throughout our lives. That's the beauty of the ownership culture in which we were born into, Dan. And so we would go down to the local grocery store and he'd say, "Hey kids, look, chocolate pudding. We own some of the company, a few shares of the company that makes that chocolate pudding. Let's go get more chocolate pudding." And so it was a wonderful way for us to be introduced as little kids to this idea of the stock market. And so when it came time after university, both my brother and I, even though we were humanities people ourselves, not finance people, we just began to write a newsletter for our parents' friends. They were the only ones who pay us $48 a year for our thoughts on the stock market as young guys. And I named it the Motley Fool. The name comes from Shakespeare. And from your own accent, I can detect that you were born closer to Shakespeare's birthplace than I was. But we always loved the character of the fools, the court jesters, the ones who could tell the king or queen the truth. They had the license to do so, the only members of the court, and they used humor. And so a few years after we got started, America Online showed up and the internet showed up. And really for us, the rest is history. We've been in as a digital company for 27 years, just trying to make the world smarter, happier, and richer. And it's just to close my answer, Dan, it's fun to hear you say our purpose. And I know you're purpose-driven as well. That's about to be my question for you. But the very first line we put on the first page of our newsletter 27 years ago was, "We're here to educate, to amuse, and to enrich." And as we thought about our purpose statement in recent years, we hailed back to that, because smarter, happier, and richer is what a world looks like if you're educating, smarter, amusing, happier, and richer. And so purpose means so much to us at the Motley Fool. And Dan, I want to turn the question around to you. Why did you join Salary Finance? You had started SoFi coming out of Stanford Business School. It's a company, by the way, much larger than my company. So you created something in 6 years that we're still not approaching after 27 years. But then moving on to Salary Finance, what was your thinking?
Thank you, David. At SoFi, we were lucky. We had good growth, and we saw really that a lot of people out there needed help. And I was responsible for business development. And a lot of what that meant was that I was approaching employers and saying to those employers, "Hey, we're seeing a lot of your employees coming to us with student loan debt. A, do you even know they have this debt? And B, do you want to do something about it?" And at the beginning, many employers were kind of sticking their head in the sand. "This is not our problem. We pay our employees. It's up to them what they do with their personal and private lives, including their finances." I think as we went on, though, we realized that view changed, and employers realized that they could help their employees and they could point them to good solutions. So when I left SoFi and took some time out and I was trying to work out what next, I met the co-founders from Salary Finance, which hails from my home country in the UK, and they had a bit of a head start. And they were really leaning into this notion of using employers and leveraging employers as a way to get good products, good financial products in front of people. And that's why I joined. It's a really efficient way to get good, solid financial products in front of people who need them. And frankly, many, many people need them. I mean, we could spend the whole time here talking about the fact that so many people are in financial stress. COVID has only added to that. And people really need help being pointed towards good solutions. Google exists, but there's almost too much out there. And I think sometimes employees, they trust their employer to point them to something good. So that's why I joined Salary Finance. We're helping those employees with their financial wellness, principally around affordable loans, but also in other areas of education and savings and insurance as well.
Quick follow-up, Dan. I'm just curious, with COVID, which I certainly wasn't predicting this time last year. I don't think many people were, and we've all had to try to evolve and adapt as best we can. One thing that showed me some promise and gives me some hope in 2020 is the savings rate of our fellow Americans. I think most recently it is about 14%, which is astronomical compared to what it's been in recent years. Down from 33%, by the way, in April, where people were really battening the hatches. But what is your perception right now of Americans and savings and where we are financially?
It's a great question, and it's very timely, just even given what's going on in Washington over the last 24 hours. That I don't think anyone has a crystal ball that is good enough to show how much help there's going to be from the government. So I think what happened is the crisis hit, and to use your words, many people battened down the hatches, and to some extent it was inflicted on them. They were stuck at home. They couldn't go out. No point buying new clothes because no one's going to see them. No, we're not spending money on fancy dinners. But to some extent, it showed that it could be done. Now, I think it's an extreme situation, and I don't think anyone would want us to stay in that situation. But it did make people take stock of where they were and perhaps rethink their lives and also their money. So I'm hoping that's a silver lining. There's a lot of pain and suffering going on. A tremendous amount of pain and suffering going on. But if there are some silver linings, I think people are now more aware of their money, and employers, importantly, are more aware that they have a job to do to help their employees. Because even if their employees are still employees and they haven't been laid off, which is great for those people, the fact is someone else in their household probably has been laid off, or someone else in their household probably is on less hours. So I think employers are realizing they have a role to play in this.
Well said. And, at least from my standpoint, the performance of the stock market has been a head scratcher throughout the year. It's been a wonderful overall year for those who would remain invested, which seems odd given the circumstances that we find ourselves in. But I will also say that after the market declined almost about a third of its value in a single month in March and April, it has bounced back. And I am seeing more people show more interest in the stock market than I think any point in our 27-year history at the Motley Fool. So again, always looking for silver linings. I'm a glass half full person. Pretty sure you are too, Dan. I think that's how most entrepreneurs are. I see an American savings rate that's higher than I would have expected, and a degree of interest and involvement in my life's work, and something that I'm just trying to spread to everybody, the awareness that the stock market is one of the best ways over time, not just in a month or a year, but over time, to grow your savings. And so I really hope that those will be a couple of legacies that we see coming out of 2020.
David, do you think that increased interest in the stock market or increased awareness of the stock market, is that just because it's, since April, it's gone up pretty much every month at a pretty steep rate, or is that fundamentally something different, something that will last?
I would say three things off the top of my head, Dan. The first is I do think anytime the market has done as well as it has, that's going to generate interest. A second factor has to be the low interest rates that we're all living through. And you would see that better than I would, and you've been part of that through SoFi. You have a real understanding of interest rates, but anytime they're down near zero, it means that we're not going to get much if we just deposit with our local bank. We're not going to get much in our CDs. And so people look elsewhere, and the stock market has always been propelled by low interest rates. And then the third factor I would think is just that A lot of people didn't have a lot to do. You mentioned, Dan, you're right, sitting at home. So there are some gamblers out there. I'm not a big fan of gambling, but I'm sure some of them are in the stock market because there aren't other games to play. So there are lots of other factors just beside those three that are driving market returns. I would say, just in closing on this answer, that some companies are doing really well and some are doing very poorly, and it's understandable. If you are a restaurant, it's hard. If you're an oil company, there's a big headwind for you going forward. If you're a digital player, you are often benefited by an environment like this. So I think there's a real bifurcation in terms of which companies are doing well and which are not. But I know you're focused on how those companies treat their employees and the financial literacy and making sure that there are good programs in place so that all employees at any company that you work with would be thriving.
Yeah, I think that's a good segue, David, to thinking about employers. I mean, through your work at the Motley Fool and Conscious Capitalism, you've seen a lot of this, but employers playing a significant role in the financial lives of their employees, whether it's financial well-being or wealth building, is a fairly novel idea for many companies out there. Yet you've long championed that notion that doing business better also includes prosperity for their employees. So can you tell us how that works?
Sure. I'll just give a few examples. Again, we're a small company. I mean, everything's relative. We have, I think, 475 employees. So not 475,000, but not just four. So that's where we are today. And here are a few of the things that we have done over our years at the Fool. And we've kind of tried to learn as we go. And we observe other companies, because part of what we do is we pick stocks. So we're always studying other businesses, looking for the best practices out there. And when they make a lot of sense to us, then we try to add them to our own culture. So a few of the things that we do, first of all, every one of our employees owns shares in our company. So when you join at the Motley Fool, you're given some shares. You're a part owner, just like we were of that chocolate pudding company I mentioned earlier. And I think the more people have a sense of owning what they do, not just the purpose, and being a purpose-driven organization is important, but then when we prosper, our employees really feel motivated, I think, to perform and to outperform on behalf of our company. So just that share ownership is important. Two other things, Dan. Another is that since we are an investing company and we're here to make the world smarter, happier, and richer and teach the stock market to as many people as possible, when you start at the Motley Fool, you're given $1,000 to buy your first stock. So for many of our employees, they have not previously owned stock. Some people come having loved the stock market their whole lives and already have a portfolio, but some have never bought a stock. And these days, through the miracle of no more commissions, because there are really no more transaction fees for buying shares for most of the big brokers today, and through the ability to buy fractions of shares. So rather than need to have $3,000 to afford a share of Amazon, you can simply buy 1/10 of a share of Amazon, be credited for that ownership at a $300 spend. So $1,000 to each of our employees lets them get started with their own portfolios. And it just makes sense if you're the Motley Fool and you are teaching the stock market to get all of your employees there, right? And then finally, we have an internal market. We remain a private company after 27 years. So if you're an employee and you'd like to sell shares, there's no market for you. Normally, we're not a public company, but we have an internal market twice a year with a third-party valuation company, not us and not our employees, who decides what they think our company's worth. And that enables our employees, if they need to or want to sell their shares back. And we even pay a dividend. So if you hold your shares, you get a dividend. So those are examples of things that we do at the Motley Fool for our employees' financial health.
That's great. And conscious capitalism, what is that? And how are you involved, and what does it promote?
Thank you, Dan. Yeah, conscious capitalism, which, by the way, is very Googleable by anybody watching me right now if you're new to that phrase. But it's just a belief that business is one of the great forces to elevate humanity. We can all think of bad examples of businesses. They often make the headlines, as the bad players seem to do in every industry. The bad athletes, the bad entertainment people, they often make the headlines. Well, the same thing happens in business, but every day, beautiful things are done worldwide by businesses. And so we believe that business elevates humanity when it's done right. And there are four basic foundations, which I'll give the 1-minute short course here, Dan. The four things that are true of conscious capitalism companies, the Motley Fool would be one of them, is number one, that you have a higher purpose. Purpose over profit. You serve that higher purpose. It's stated, management owns it, your customers know it, etc. The second foundation of conscious capitalism is that you manage for all stakeholders' success. So you and I are talking today about a really important stakeholder group. That would be the employees of a business. Some businesses run their employees down, don't care about them, just try to squeeze them, pay them as little as possible, and try to make as much profit off of their efforts as possible. That's the opposite of how we think you should be managing a company in conscious capitalism. But it's not just your employees, of course. It's treating your customers right. It's treating your shareholders right, your partners, your suppliers. But traditionally, Dan, business was often taught, I don't think you probably learned this at Stanford Business School, but 40 years ago, most of the Fortune 500 CEOs would write, the purpose of our business is to maximize shareholder value. Well, that's become a real bugaboo for people like us, and maybe you too, who think that that's really not the way to run a business. You need to win for everybody, not take one group and say, we're just going to max it out for them. So that's the second. The third and the fourth foundations of conscious capitalism are just conscious leadership, which is pretty synonymous with servant leadership. And the founder of this movement, John Mackey, the founder of Whole Foods, just is out with his book, Conscious Leadership, this fall. So you can find it on Amazon. But if you want to learn a lot more, I think it's a wonderful book about leadership. And then finally, fourth, conscious culture. So which are the companies that people love to go work for every day, that feel motivated to put out their best effort? Well, it's probably because they have great cultures, cultures that have awakened to the importance of treating employees right. And so those are the four: purpose over profits, stakeholder orientation, conscious leadership, conscious culture. So there's my short course on conscious capitalism. I'm on the national board, and it's something that means a lot to me. And I see you nodding your head, so I think that these things are speaking to you as well.
Yeah, we should talk afterwards on how we can sign salary finance up, because that's certainly in our DNA. So thank you for that.
You're welcome. And Dan, let me turn the question back on you now. What does it mean in your mind to do business better? What type of role do you think that responsible employers, I mean, you're working with the employers through your business, trying to find the good ones or trying to get the bad ones to get better. What role do you think responsible employers should play in the financial wellness of their employees? I certainly grew up in a world where it wasn't expected that you'd be looked after as an employee in terms of your finances by your CEO.
I think it's changed a lot, even just in the last couple of years, and I think it continues to evolve. I think if you go back probably only 5 or 7 years ago, most employers, in terms of an employee's finances, would provide a 401k or some kind of retirement planning option, and then healthcare to kind of keep you healthy and stop you getting into medical debt. But that's another issue by itself. But beyond that, there wouldn't be much there. And I think that partly because of levels of trust in the media have fallen, levels of trust in the government have fallen, traditional institutions have fallen. There's a lot of studies out there that show this. And really the employer remains this kind of tall standing bastion of trust that employees believe has their interests at heart. So I think employers have woken up to that fact and are now leaning in, if you excuse the expression, and really wanting to help their employees in as much or in many other ways that they traditionally haven't. So many of them are offering them access to savings products or more affordable lending products, or just financial education in general. I mean, even that is a great start. David, I'm conscious of time. I want to get to your title of Chief Rule Breaker, because that sounds like a pretty cool title. What does it mean, and how does it impact your efforts in your daily work?
Well, it has a double meaning, like a lot of things around the Motley Fool. The first is just very simply that my own style of investing and what I've taught and written books about over the years is called rule breaker investing. I'm looking for the disruptive companies, the ones that come along and break the rules of the industries in which they operate. So you think about Netflix growing up in a world that Blockbuster dominated. That's an example of a rule breaker. They're not being Goliath, they're playing the David out there. And so those are the stocks that I love and invest in. And I have some traits and things that I talk about around rule breaker investing. But then just internally, my role in part is just to challenge the conventional wisdom that we all can fall into at a company-wide level. So I as a co-founder, I take that very seriously. And I'm sort of the person who likes to question what we're doing. Ultimately, I love what we're doing. I'm totally supportive. My younger brother, Tom, is our CEO. He's done a spectacular job. So he's accorded me the role of occasionally being the court jester to the company. Enough about chief rule breakers. You're right. We are short on time, Dan. Let me flip things back to you. You and I were talking yesterday a little bit in preparation for this event about how still so often today, money and financial health is a taboo subject, not just in families where often it is, but in the workplace, understandably. Is it time that ends?
It is, and I've spoken to many an HR person at a big employer or a small employer, and again, a bit similar to my earlier answer, that the initial stance perhaps a few years ago was, this is not our business. Like we should not be in this world. And I think employers overestimate how much their employee, or rather they underestimate their employees' willingness for them to be involved. So I think, I'm not saying that there aren't stigmas. There are still stigmas around finances and lending and borrowing. These aren't topics that we naturally use as first points of conversation without, new colleagues. Guess how much debt I'm in? But I think society is changing, and I think certainly the younger generations are more open on this stuff. And people are sharing their salaries and they're sharing information about how to invest, whereas perhaps older generations keep a little more buttoned up, and it's like, this is rude stuff to talk about. So yeah, I think those taboos are gradually breaking down, and employees are welcome their employers being involved in this stuff, which I think is a welcome development. I mean, always you want anonymity if employees want that anonymity, and I think third-party providers of services in this area, like ourselves at Salary Finance, we provide that level of anonymity. But I think sometimes employers overestimate how much that's important to people. Ultimately, they want better savings and better loans. And if you can give them that as an employer, they don't really care if you know or not. So yeah, I think the taboo is slowly going away, but we need to keep chipping away at it because it's a long journey.
Completely agreed. High time. And I know our respective organizations are working hard to spread as much awareness about finance, as much financial health as possible. So, and thank you, by the way, Dan, for sponsoring this track, the deep dives, the financial health track sponsored by your company, Salary Finance. So
I appreciate that. I did, David, before we go, we're running short of time. I did mention at the beginning that we had a Steve Jobs related anecdote. So I feel like I should hand the floor over. And for everyone watching, I have not heard this either, so I'm reacting in real time. We'll see how good this one is.
Okay, good. So the one time I met Steve Jobs, he was keynoting at a conference. My brother and I had spoken that morning. He spoke in the afternoon, and he was talking at the time, this is 20 years ago, he was talking as the CEO of both Apple and Pixar. And he was being taken to task by Wall Street because they're like, you are spending CEO at 2 different public companies, and 1 day out of 5, you just interview new employees. That seems crazy, and you should reallocate your time. And he said, and this was what I'll always remember him saying, he said, I think most people think that the average, that a good person, a really good person, a new hire at Salary Finance is 3 times better than the average person. He said, but in my experience in life, somebody who's really great is not 3 times better than average. They're 40 times better than average. And so that's why I spend 1 day out of every week, even though I'm CEO of both Apple and Pixar, simply interviewing new employees for those companies. And I think, he said to Wall Street, I'm allocating my time properly. So it's a real celebration of excellence. And not everybody may embrace that, I'm not sure, but at least Jobs always put himself out there in terms of his strong viewpoints. And it's something that I generally feel is truer than not. And so it's a reminder. I see that all the time in public companies and stocks. The really great ones just multiply hugely in value, whether we're talking about Berkshire Hathaway or Apple itself, so much more than the merely average ones. So words to live by.
Thank you, David. I think that is a good note for us to end on. We are up on time. Apologies we didn't get time for the questions. David, thank you. Big thank you for your time today and for your insights. Thank you, David.
Thank you, Dan. I really enjoyed my time full on.
Thank you. Okay, I have the stage now because this is the closing comments. As the sponsor, Salary Finance, I get this pleasure. So thank you to the organizers for that. Very quickly, thank you today to all the panelists for the insight and the important work that they're doing. And thank you to all you, the attendees, for being here to engage with us and to see what we can do to be part of this fintech ecosystem. As our Salary Finance co-founder, Asesh, mentioned at the beginning of this track session earlier this afternoon. And as the conversations between now and then have certainly shown, we all have a lot more work to do in this area, but there are very promising signs in innovation that are shifting and shifting thought models that have been discussed today. And we'll hope that you'll carry these through to your own companies or organizations and join with us to be part of pushing these conversations forward. Whether it's new models for helping people access affordable capital, coming up with innovative models for savings, or envisaging a better future for all working people, here at Salary Finance, we're excited to be part of building the solutions that can really improve financial health for all people in the future. And now that you've heard a bit about what we do and how we help employees from multiple members of our team this afternoon, please feel free to reach out to me directly if you're interested in learning more or partnering with us. Finally, thank you to the Technology Association of Georgia for organizing this event today and for working with us to create such a compelling set of sessions today. Thank you, everyone, and goodbye for now.